Today, catching a falling knife. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. This is just a quick update looking at the market movements in Australia today following the significant falls in the US, which I covered in an earlier post and which you can watch separately. So I just want to go through the market here and underscore what's happened over the last 24 hours. It's quite significant falls across most sectors, and it'll be very interesting to see whether this is just a flash in the pan or whether it's the start of something more serious, because of course the Federal Reserve is now signalling interest rates will be higher sooner, and the quantitative easing programs may well be ending. Let's see whether they follow through on that. That will have a significant and profound effect on the market over the long term. So let's start with the ASX 200, which fell 2.74% to 7,358. The Financial Services Index fell 2.34% to 6,544. And the Real Estate Trusts fell 4.43% to 1,690. Not surprisingly, perhaps the Volatility Index was significantly higher. It was up more than 23% to 13.525, and that's pretty significantly up, but as you can see, still somewhat lower than what we saw back in 2019-20. The ASX 200 futures was also down 1.91% to 7,319, suggesting that there will be further falls ahead. Amongst individual stocks, ANZ was down 1.35% to 27.68. CBA fell 3.13% to 99.97. NAB was down 2.16% to 28.97. And Westpac was down 1.65% to 21.48. Amongst the regionals, Bank of Queensland was down 1.93% to $8.13. Bendigo and Adelaide Bank was down 1.95% to 9.07. And Suncorp was down 1.05% to 11.32. And Macquarie was down 2.98% to 209.30. AMP was down 2.97% to 98 cents. And the Magellan Financial Group was down 2.95% to $20.40. QB Insurance was down 0.25% to $11.97. And Insurer IAG was down 0.68% to $4.36. While Iris was down 4.45% to $12.24. The mortgage insurer Genworth was up 0.43% to $2.35, while McGrath was up 0.82% to 61 cents. And Yellow Brick Road was at 0.125. AFG, the mortgage aggregator, was down 3.35% to $2.60. And amongst the miners, BHP was up 0.12% to 42.68. Regis Resources was down 3.43% to 183. Mineral Resources was down 0.84% to 57.94. Fortescue Metals was down 1% to 19.75. Newcrest Mining was down 3.1% to 24.03. And Rio Tinto was up 0.73% to 101.31. South 32 was down 1.24% to 3.97. And Champion Iron Ore was down 1.23% to $5.61. While Bowen Coking Coal was up 2.86% to 0.18. Whitehaven coal was up 3.27% to $2.66, while Santos was down 2.65% to $6.60. Woodside Petroleum was down 2.46% to $22.21. And the real estate group REA was down 7% to 156. Qantas was down 1.76% to 501. Wesfarmers was down 2.88% to 58.08. And GrainCorp was down 1.1% to 8.34. While Xero was down 6.52% to 131.50. Afterpay Touch was down a further 10.76% to 71.85. And Altium was down 5.79% to 41.17. Of course, a lot of those stocks are being driven lower because with interest rates rising, their future profitability is under pressure, and the discounted rates at which future profits are considered changes. And Goodman Group was down 6% to 24.29. Stockland was down 3.41% to 4.25. Cymec Building Group was down 2.12% to 16.65. And Aristocrat Leisure was down 4.46% to 43.25. So very little place to hide at the moment in the markets. The Aussie US dollar was down 0.9% to 71.55, and I expect more downward pressure ahead, while the euro Aussie dollar was up 0.88% to 1.5804. In terms of yields, the 2-year was down 0.88%. The 3-year was up 0.1% to 1.021, and the 10-year was up 0.22% to 1.851. The Aussie Gold Cross was up 0.14% to 2,513.24, and the crypto EFT was down 8.49% to 701. Bitcoin Aussie Cross was down 6.81% to 60,192. And in dollar terms, Bitcoin was down 7.31% to 43,028, while Ethereum was down 10.63% to 3,409. So you can see there considerable falls across the market. The question will be whether those falls stick, or whether the market will bounce back in the next trading session. And that will tell us quite a lot about what's going to happen ahead. But I do expect much more volatility than we've seen, and I still think the markets are considerably overvalued. They, of course, have been banking on continued central bank support, and if in fact that central bank support is whipped away through interest rate rises or through the end of quantitative easing, then prices, frankly, are way over where they should be. So I do expect to see more corrections, but it will be volatile. There will be up and down. And of course, large players will be able to make significant profits on volatile trading. Small individual holders, less so. Remember that many of those won't even see the true market depth of data on the trades and will be, frankly, trading with one arm tied behind their backs. One of the problems with effectively a two-tier market, the major markets dominated by the major players, and all the retail investors and everybody else just coming up a very long second. So that's a quick update. Hope you found it useful. I'll look forward to seeing you next time. This is Martin North from Digital Finance Analytics.